All right, guys, welcome back to another one, Rogue Macro. Check out roguemacro.substack.com. Follow me on Twitter at roguemacro underscore. This was a blog post I put out yesterday. Make sure you subscribe to the Substack because I'm starting this new thing. Every Monday, we're going to do a free blog post. Every Friday is going to be the premium content. On my other blog, which is bitcoinandmarkets.com, I'm going to be putting out more Bitcoin centered free content, but the paid tier is going to be the same for both. You're going to get the same paid pro content on both websites. So check out roguemacro.substack.com. Yesterday, I wrote about oil shock or not. Is this the culmination of long-term trends or a financial overreaction? This was the hot topic yesterday. Prices exploded at market open all the way up to 120, and people were saying this is going higher. Of course, a lot of people talk about $150 a barrel oil, $200 a barrel oil. I am in the camp of we are heading towards structurally weaker oil prices, lower oil prices for the foreseeable future. And we'll get into that why on this one. Recent U.S. military operation involving Iran has spilled into the Strait of Hormuz, obviously. Many analysts long claimed the strait could never truly be closed. Yet in practice, it effectively has been. So these analysts, I'm talking about those guys at the big firms from Goldman Sachs, JP Morgan, whatever, these analysts are saying it would be so disruptive that they didn't think it could ever truly be closed. It would just be too disruptive for all parties, not just for the West, but for the East, for China, for Iran itself. And so there wouldn't be, and the game theory was they thought that it could never truly be closed, but in practice now it has been. It wasn't closed by decree from Iran, but by insurance markets. After several tankers and civilian vessels were struck in the region, London maritime insurers rapidly withdrew war risk coverage. Shipping companies suddenly faced massive premium increases or no coverage at all. Even where policies could be renegotiated, many firms were reluctant to send vessels through the area. The result was a sudden disruption in shipping flows and a violent speculative reaction in oil markets. That's exactly what it was, a speculative reaction, not a structural shift in oil fundamentals. This is the main idea of this post. Okay, it was a speculative reaction, not a structural shift in oil fundamentals. Here is the chart that I included. This was the daily chart. You can see coming into this pink resistance, which we'll look at more down below, shot up all the way up to 120. And at the time of writing was down to 95. Currently, we're sitting at 86 for oil. So it has mediated quite a bit. And I expect that, after a few bounces here and there, I do expect over the next month or two for price to trend back down to 70, even into the 60s. That is where oil is naturally should be at this point. For many years, analysts have predicted a coming surge in oil prices due to peak oil. You've probably heard that term for many decades, that we've maximized the output from the ground and it's just going to diminish. So that has been debunked over and over again for the last several decades. We continue to find more and more proven reserves. Proven reserves increase every year. That means the amount of oil still in the ground increases every year, even though we're pumping 1 million barrels a day out of the ground. There's also a newer kind of idea called peak cheap oil, and that is from Luke Groman has tried to popularize this. Of course, this also has not turned out to be correct. When a spike like this occurs, they claim vindication. But those arguments were always about tight physical fundamentals driving higher prices. And what do we have here? We have a speculative reaction driving higher oil prices. So that is not what happened here at all. The current oil market is fundamentally characterized by oversupply. Major forecasting firms expect 2 to 4 million barrels per day of surplus production in 2026. So there's some forecasting firms out there. If we go quickly back to Friday's pro post, all right. So we take a look at this table. So the IEA, they said we were going to have 3.7 million barrels per day of surplus. Morgan Stanley down here, 1.9. So between 2 and 4 million barrels per day of surplus, that is what they're saying. Also on Friday, this is before the huge reaction. We had, if you take a look at the price, let's see, where Where do I have a price on this? Well, right here we can see front month is at 92. So this was on Friday when price hadn't broken 100 yet. It was still sitting at 92. And this was my conclusion. So markets reacted quickly to a military operation in Iran, pushing front month oil above 90 on fears of a Strait of Hormuz disruption. But the futures curve tells a different story. Longer dated contracts remain far lower, indicating traders view the spike as temporary geopolitical premium rather than a structural supply shock. Okay, so that brings us back to what we are talking about in today's blog post. That one is for pro members specifically, and I detail out the what's exactly happening and why it's happening and all of those things. But okay, so where were we here? This geopolitical episode may temporarily tighten flows, but it does not change the broader structural balance. Okay, so going back to this 2 to 4 million barrels per day of surplus production, that's what we're in. That's what we're in right now. Estimated in 2026, 2 to 4 million barrels surplus a day. Where does all that go? Well, it goes into inventories mostly. So overall, we are in this period of oil glut, oil oversupply, and a temporary disruption in the Strait of Hormuz is not change that fundamental characteristic of oversupply. It's a temporary tightening of flows is all. That's all it is. Okay, here's a longer term chart. You can see spikes in price around specific events. Russia Ukraine starts October 7th. You can see the market actually priced in October 7th before it occurred, which was very interesting. Um, and then here, I thought we were this red support turned resistance. I thought we were going to stay below there for a while, but it did break above with the 12-day war, which is understandable. And it quickly went back down, went back under over the last few weeks in really in most of 2026. The market has been anticipating something, and so its oil price strengthened back into this long-term support turned resistance zone. And then when the bombs really started falling is when we had this financial snap and things just went higher very, very quickly. That's not how a sustainable move looks. You can just look at this and know that those analysts claiming we're going to $200 a barrel and it's be sustained at these higher levels, they don't know what they're talking about because this is just a financial break. Okay. It was a short squeeze and it just went higher. For oil prices to rise and remain elevated, the world needs strong economic growth. Military destruction doesn't help. And we already know that deglobalization and demographic decline negatively affect baseline economic growth and therefore oil demand. So, what do I mean there? Deglobalization. The reason why we globalized was to get more efficient. What happens when we deglobalize? We are getting less efficient but more secure. We're trading off efficiency for security, which is a negative effect on actual economic growth. So if we're reindustrializing, we're shortening supply chains, we're deglobalizing, these are negative forces for overall economic growth. And demographic decline is also one of these negative factors. So as people age, so there's fewer young people, there's more old people. People are aging up. There's going to be like one person, one worker for every three retirees or something like that that needs supporting. Well, these old retirees, they consume less. People consume the most between ages 25 and 55. Once they get into retirement age, they're consuming about 80%. And if as they get over 75, they're consuming about 50% of what those people in the prime consumption ages are. You also get a total population decline, an absolute decline. Japan is approaching 1%. They're close. They're still under 1% decline every year, but they're getting close to 1% decline. China is at 0.25% every year, and they're rapidly going to be approaching one in the next 5 to 10 years. Europe is in those places. The US is still slightly growing, but it is topping in the next 20 years and it will be declining. So we have this demographic decline and aging that is a negative effect on baseline economic growth. I'm sorry, but if you're Japan and your population is 125 million, you're going to have a certain demand for energy. But if your population is 100 million, 20% less, you're going to have a lower energy demand. for 100 million versus 125 million. Fewer people are going to require less energy. And if you're also deglobalizing at the same time, your growth is going to be slowing or going negative, and you're going to be demanding less energy anyway. So, on the flip side of that, these negative uh, forces on total demand, we also have inelasticity of demand. So, demand tends, in the short term at least, it tends to be pretty sticky. Okay. People must commute to work. Freight must move. Aircraft must fly. In the long term, people can get laid off or retire, but in the short term, they must commute. So, see, in the short term, um, oil demand is inelastic, or we could say sticky. That means consumption does not fall when prices rise because you still have to use it. Fuel consumption continues regardless of price. Instead, the adjustment happens elsewhere. So, in the short term, the adjustment happens elsewhere. If you have to pay more for gas, if you have to pay 25% more for gas at the gas pump, well, you're going to have less discretionary spending. That spending is going to come out of somewhere else in the economy. Slower economic activity. Businesses are going to have fewer hires. So you're going to have rising unemployment. That's the short term consequence. But in the long term consequence, oil demand can change. Okay. It's not perfectly inelastic. Empirical estimates suggest that in the short run, oil demand elasticity ranges roughly between 0.03 and zero point 0.1. That means a 10% increase in price reduces demand by only less than 1%. Over longer periods, demand becomes more flexible as consumers and industries adjust behavior. They improve efficiency inside their company, or they find substitute fuels. Long run elasticity estimates suggest 10% price increase may reduce demand by 3 to 8%. And we're talking about this went up 70 to 80%, the price increase in oil. So if the price increase is 80%, I mean, we're looking at like a 50% reduction. It could be over the longer term, right? So we go back to this line right here. For oil prices to rise and remain elevated, the world needs strong economic growth. And we simply don't have that. That's why this is a temporary financial snap, and it will return back down to 70, 60, maybe even 50 going forward in the next couple years. We will get back down to those levels. So let's just wrap this up. For now, the charts tell a simple story. A geopolitical shock triggered a financial snap higher. Within hours, the market reversed. This was a financial event, not the beginning of a structural oil bull market. That's it for this one, guys. Check out roguemacro.substack.com. Follow me on Twitter at roguemacro_. Hope you're having a great day, and we will see you guys on the next one.